Listen to me. If you are standing there, looking at your smartphone, wondering if this app called Kikoff is going to slide cold, hard cash into your pocket that you can use to pay your electric bill, buy your groceries, or help your grandkids, I need you to pause. I need you to step back, put your phone down, and listen to every single word I am about to tell you. Because what you don't know about how these modern financial technology apps work can cost you your hard-earned money, cause you immense frustration, and leave you empty-handed right when you need cash the most. The short, direct answer to your question is a resounding, definitive no. The standard Kikoff credit account does not give you one single dollar of spendable money. Not a dime. It is not a personal loan. It is not a standard credit card that you can take down to the local supermarket or use to pump gas into your car. If you sign up for Kikoff thinking you are getting a $750 or $3,500 cash loan that you can withdraw and put into your checking account, you are making a massive mistake. You are misunderstanding the entire ecosystem of credit-building tools, and that misunderstanding is born out of a very real, very justified fear that I see across this country every single day. You worry that if an emergency happens, you won't qualify for a decent loan or a credit card with a fair interest rate. You see an advertisement online for an app that promises a $750 line of credit with no credit check, no interest, and no hidden fees, and your mind instantly jumps to hope. You think, finally, a lifeline. Finally, some extra breathing room. But you have to look under the hood. You cannot afford to make financial decisions based on assumptions. Because payment history makes up 35% of your credit score, and credit utilization, how much of your available limit you use, makes up another 30%. This structure is designed to make your credit score go up. It simulates the behavior of a perfect credit card user without ever giving you an actual credit card. It is a credit gym. You are lifting financial weights to build your score, but you aren't buying anything real. You are paying a monthly fee for the sole purpose of generating a positive line item on your credit report. So, let me ask you, does that give you money you can use? No. In fact, it does the exact opposite. It takes money out of your pocket, that $5 to $35 a month, and gives you a higher credit score in return over time. It is a service you pay for, not a source of funding. Now, I know what some of you are thinking. You're saying, Susie, I read that they have a card. I saw they have a Kikoff Secured Credit Card. Yes, they do. But let's clarify exactly what that is so you do not fall into another trap. A secured credit card is entirely different from a traditional credit card. With the Kikoff Secured Card, you have to take your own money from your Social Security check, your pension, or your savings, and deposit it into a Kikoff cash account. If you put $200 of your own money into that account, your credit limit on that card is $200. You're spending your own money. Yes, you can use that specific physical card at an ATM to withdraw cash, but you are only withdrawing the cash that you previously deposited. It is a debit card masquerading as a credit card for the ultimate purpose of reporting your everyday purchases to the bureaus. It does not provide you with emergency capital. It does not extend you a single dime of leverage. The big question you need to ask yourself right now is this. Is a tool like Kikoff what you actually need at this stage of your life? If you are a young adult trying to buy your first home, building a credit score is vital. But if you are retired or about to retire, you have to ask yourself why you are chasing a higher credit score and at what cost. Are you planning to take out a massive mortgage in the next 12 months? Are you planning to finance a brand new car with a heavy monthly payment? If the answer is no, then why are you paying a monthly fee to an app just to watch a number on a screen go up? Your priority right now must be liquidity. Your priority must be cash flow. You need real money in a high-yield savings account that you can touch, that you can spend, and that earns you interest, rather than you paying a company a monthly fee for a cosmetic fix to your credit report. If you are facing a cash crunch, using your limited monthly income to pay for a credit-building service is not the answer. It is a distraction from the real issue. So, what is your actionable takeaway today? First, if you need immediate money for living expenses, look away from fintech apps like Kikoff, Self, or Credit Strong. They will not help you buy food tomorrow. Instead, protect your cash. If your credit score is low simply because you don't use credit cards anymore, let it be. Having a thin file or a lower score because you live debt-free is not a financial tragedy in retirement if you own your home or have stable housing. Do not pay an app $60 to $400 a year just to change a score you might not even need to use. Second, if you absolutely must build your credit score, perhaps because you need to move into a new rental apartment soon and landlords are checking your history, do it the zero-cost way. Do not pay a monthly membership fee. Go to your local bank or credit union where you have kept your money for years. Ask them about a traditional secured credit card. You put down a deposit, you use it to buy your groceries once a month, you pay it off in full immediately, and it builds your credit for free without feeding your hard-earned dollars into an app's ecosystem. You have worked too hard, for too many decades, to let your money slip away into services that do not serve your immediate financial safety. Stand in your truth. Recognize exactly what these apps are selling. They're selling credit history, not cash. Keep your money in your bank account where it belongs, protect your cash flow, and stay secure.